Some pretty big changes are coming down the pipe for Canada's mortgage and banking rules, and they're going to affect just about everyone, from first-time buyers to current homeowners. So in this explainer, we're going to break down exactly what these new reforms mean for you and for the housing market as a whole.
Okay, so here's our game plan. First, we'll look at some changes that are making the path to a first home a little bit easier. Then, we'll get into what's new for homeowners who want to add a suite to their property. After that, we'll pull back the curtain and see how your bank is being kept safe. And finally, we'll wrap it all up with a quick summary of all the new rules.
All right, so let's dive right into the big one, the topic that's on a lot of people's minds, the changes designed to help more Canadians finally get into their very first home.
So, what's the deal for new buyers? Well, the government has rolled out a few key changes that are really aimed at making that first big purchase just a little more within reach. First things first, the whole idea of what a first-time home buyer even is has gotten bigger. It's not just for people who've never owned a home before. Now, it also includes folks who haven't lived in a home they owned for the last 4 years, and even people who are recently separated or divorced.
Now, this is probably the biggest change for a lot of new buyers. You can now get a 30-year mortgage instead of the standard 25. So what's the trade-off? Well, it's pretty simple. Your monthly payments will be lower, which can really help you qualify for the loan in the first place. The catch, though, is that you'll end up paying way more in interest over those extra 5 years. We're talking tens of thousands of dollars more.
And to reflect the reality of today's housing market, especially in the big cities, the government has also bumped up the price cap for insured mortgages. It's now $1.5 million, a big jump from the old $1 million limit.
All right, so that covers the first-time buyers. But what if you already own a home? Well, there are new rules for you too, specifically designed to encourage people to build more rental units, like a basement suite or a laneway house.
So who exactly can do this? Well, the rules are pretty specific. For starters, you have to already own the home. You or a close family member has to be living on the property. The goal here is to build brand new, self-contained units, and this is a big one. You absolutely cannot use them for short-term rentals.
The really cool part here is how you can fund these additions. There's a new, streamlined process where you can refinance your mortgage based on what your home's value will be after the renovation is done. This makes it a lot easier to get the cash you need for construction right up front.
And to make this a realistic option, even in some of our more expensive housing markets, the maximum as improved value for this kind of refinancing has been set at $2 million. This higher cap really acknowledges just how much property and construction can cost these days.
Okay, so we've talked about making it easier to get a mortgage. But let's look at the other side of the coin. What about keeping the whole system safe and stable? Well, there are some new behind-the-scenes rules for the banks to make sure Canada's financial system stays secure.
The first thing to understand is something called capital adequacy requirements. Now, it sounds complicated, but just think of it like this. It's basically a bank's mandatory rainy day fund. It's a certain amount of cash they have to keep on hand to act as a shock absorber if things go wrong.
And you don't have to take my word for it. Here's what the banking regulator OSFI has to say. Basically, these rules make sure that even if a bank makes some bad loans or investments, there's still more than enough money in that emergency fund to protect your deposits. It's all about making sure your money is safe, no matter what.
Now, this is super important to get. This is an internal, behind-the-scenes rule for the banks. It affects how they manage their own books and their own risk. It does not change a single thing about how you personally qualify for a mortgage. Your application process stays the same.
Okay, another new guardrail for the banks is the loan-to-income limit. Think of this like a speed limit on how much risky lending a bank can do overall. It's not a hard and fast rule for every single person, but a limit on the bank's entire portfolio of new mortgages.
So, what does this look like in the real world? Well, it means banks can still give out some of those loans that are more than 4.5 times a person's income, but that can only be a small slice of their business. The vast majority of their new loans have to stay below that limit.
All right, we've been through a lot of details, so let's pull it all together and do a quick summary to tie everything up nicely.
So to put it all in one place, for first-time buyers, you've got that 30-year option to help lower your monthly payments. The price cap for an insured mortgage, that's been boosted to $1.5 million. For existing homeowners, it's now easier to finance adding a new rental unit. And finally, for the banks, there are new rules in place to keep the whole financial system stable and strong.
When you step back and look at it, this is all a really interesting balancing act, right? On one hand, you're trying to open the door for more homebuyers. On the other, you're reinforcing the walls of our financial system to keep it strong. The goal is to create both access and stability. But the big question we're left with is, are these the changes that will finally reshape Canada's housing landscape for the better?